This clip is Lyn Alden defining reserve currencies, explaining why the US dollar has that status today. What are the characteristics? What are the benefits? Why is it likely to last for a while? And why is it certain to collapse over the long run? This is excerpted from a full interview I did a month ago, and please see that if you'd like more detail. On to the clip. Lyn, I'd like you to set the stage first by explaining what it means for the U.S. dollar to be the reserve currency, and what are the primary factors that have allowed it to maintain this status for so long.
Reserve currencies have network effects. They have, self-reinforcing liquidity. They rely on deep capital markets. But basically, the short answer is it's the primary currency that nations around the world gravitate to for a variety of different purposes of money and saving, transacting, all those types of activities.
How difficult is that to be unseated? You discuss, these network effects make it seem pretty embedded. How likely is it to wane over time, or how do reserve currencies lose their status?
It's extremely likely to wane over time, but it always lasts longer than people think is kind of the two-sided answer there. One of the kind of the narratives I've seen, you'll see this chart of like historical reserve currencies lasting, 80, 90 years, and it goes back to, about 500 years or so. But in practice, we really only have two actual reserve currencies because, if you go back far enough, it was mainly you're talking about European currencies. You're not really talking about world currencies. There wasn't enough kind of speed of communication and speed of travel to really have any sort of global currency. So really precious metals were the global currency, and certain IOUs had more liquidity and acceptance across Europe than others, but there wasn't really such a thing as a true reserve currency. The British pound, in some ways, was kind of the first world reserve currency, meaning it had some degree of global liquidity acceptance. But even then, it was really tied to gold. And so kind of the first reserve currency, the first like 100% true reserve currency would be the dollar, which is to say that the dollar itself, the treasury itself, is the reserve currency. It's not an IOU for something else like gold. And the network effects are very powerful because, they're reinforcing, right? So there's no other currency that's liquid enough. There's no other capital market in the world that's deep enough. And fracturing into multiple capital markets is generally a lot more problematic. Um, and The other big factor is the debt is self-reinforcing. So the debt represents inflexible demand for that currency. And so when you have over, say, $13 trillion in debt for dollars around the world outstanding, plus other types of contracts that it's very opaque, all of that represents inflexible demand for dollars. And the ironic thing is often not even owed to the US, it's owed to other countries. Country XYZ in Latin America or Africa will owe dollars to an entity in China or Europe or Japan, for example, in many cases. Um, and so basically, it's a very multi-decade, very long-term network effect, very powerful. And it really, until there's something big enough, sound enough, liquid enough, acceptable enough, it's very hard to unseat. Now, what I would argue, though, is that it's kind of self-defeating in the long arc of time, in the sense that, world reserve currency, there's so much demand for that currency, just almost by necessity. That kind of props up the value of the currency. So a lot of currencies trade on things like interest rate differentials and trade balance differentials. And they're kind of self-correcting over, a couple business cycles, whereas the world reserve currency has this extra layer of a monetary premium on their currency. And so there's plenty of upsides to that, but the biggest downside is that it makes your import power very strong, your export competitiveness very weak, especially for kind of lower margin, physically made goods and things like that. And so you kind of hollow out your own domestic, say, manufacturing capability. And in the long arc of time, you can undermine the economic foundations that kind of got you that reserve currency in the first place. But that's not a multi-year story. That's like a multi-decade story. So I think, in the long arc of time, it's not very sustainable. And there's embedded imbalances in the way the system's constructed, but they take lifetimes to play out.
What is it that you think is going to erode the U.S. dollar's status as a reserve currency over this long arc of time? Is it too much debt?
Couple main variables. One is it's starting from an unsustainable position, which is that after World War II, the United States was, you're 4% of the population, but like, almost half of global GDP, right? That was like the most, consolidated that economic power ever was, with the rest of the world just destroyed by war. And so that a broadening out is, if anything, the natural state of affairs. So you're kind of just you're mean reverting in some sense to balance. Not perfect balance, but from away from the biggest extreme in history. So number one is just the it's not really big enough per se to be the world reserve currency anymore. Like there's no one country big enough to be the kind of the global reserve currency indefinitely, generally speaking. The other one, as you point out, would be debt, which is to say that we've had decades of accumulated fiscal deficits, rising debt, more importantly, rising debt to GDP, and then that was offset by 4 decades of falling interest rates, which made interest rates, expenses serviceable to manage. The problem is that when you run into zero and start going sideways, that fiscal debts and deficits become less sustainable. In addition, if you look at the long arc of time for U.S. Treasuries, they spend the majority of the time, yielding below nominal GDP growth or yielding below money supply growth, meaning that holders of those are getting gradually diluted as a share of the dollar network. And the biggest exception for that period was kind of that 2 or 2.5 decade period starting in say the early 80s and going into the 2000s. That was where they had pretty high real yields, and they kind of inserted themselves as being very attractive even relative to something like gold. But as you get very indebted, your ability to maintain those high real yields, especially compared to high hurdle rates like nominal GDP growth or nominal money supply growth, become virtually impossible. And so that the attractiveness of the asset becomes diluted compared to scarcer things like, let's say, for example, gold. There's also censorship problems, which is to say that if the United States is willing to never kind of freeze or confiscate anyone's reserves, and then entities can treat it as like good as gold. But if the U.S. kind of weaponizes its ability to freeze assets or confiscate assets, whether or not they feel they have a good reason to, the world consists of countries that are not necessarily friends. And if they say that there's even some reasonable chance that their assets could be frozen or seized in any way, then they have an incentive to either diversify or to hold assets that can't be seized, some combination thereof. And so for a kind of a combination of reasons, I think it's becoming increasingly untenable for the US to maintain its current share. But that doesn't mean that in a given year or two it goes away. It has these massive network effects. So instead, I think what we're seeing is a broadening out and a more multipolar world in terms of reserve assets, neutral reserve assets, bilateral trade with kind of non-dollar currency agreements, despite their frictions. And I think the world's shifting away from that kind of unipolar world, kind of that, the fall of the Soviet Union, 30 years of kind of America, the hyperpower. And I think we're kind of gravitating toward multiple different spheres of power.
This show is being brought to you by our sponsor, Truflation. Professional investors and economists, and probably any casual observers, know that government inflation statistics are only an approximation of what real inflation is. Not only that, but the government has a conflict of interest because high inflation can be so damaging to the economy, the deficit, and our $34 trillion in debt. Truflation collects over 13 million pricing data points. Most are updated daily to reveal inflation with precision for asset managers, governments, companies, and the general public. Check them out at truflation.com. Hey, if you like this clip, please hit the subscribe button. You might also want to check out some of the clips I've posted with my many other guests. My interviews all address the simple question, how screwed are we? We ask experts about the problems that make Americans so pessimistic today, but we also explore why there's never been a better time to have been born than today. Join us for perspective on today's challenges and opportunities.